At whether we have another bad bank in the US. New York Bancorp seems to be showing some considerable stress signs. We're going to have a look a little bit deeper at what's going on there. And then the trading takeout today is going to be whether you need loads of screens or whether you're better off with few. Make sure you like this video and subscribe to the channel to ensure that you get the best market information daily right into your YouTube feed to maintain your trading edge. Seems like there are massive problems for New York Community Bancorp, one of the banks that was actually involved in last year's big bank bailout. They bought the assets of Signature Bank, which failed back in March, I think last year. I think it was March, maybe April. But you can see their share price, it is absolutely battered. It's now down over 50% in the last week or so, I believe. Yeah, say the last 5-6 trading sessions, it's down 50%. And this is mainly due to fears over its commercial property holdings and also some of those assets that it held, from last year. Now, Moody's has actually just downgraded it. Let me just find the article again. They've just downgraded it to junk status, which is pretty big. Let me just grab this now. I just had it up. I don't know where it's gone. So there's a CNN article just from a few hours ago. Let me just share this tab. There we go. So, embattled regional bank New York Community Bancorp suffered another blow Tuesday evening as Moody's Investors Service downgraded its credit rating to junk status. Now, this is the lowest credit rating that your bonds can get, basically, that your debt is graded as junk. It means that the interest earned is massively high to compensate for the risk of holding their debt. So it makes perfect sense here, and I don't know who would come in and buy this debt. It seems really, really poor, but you can see here what Moody's have said. The downgrade was driven by concerns about challenges facing New York Community Bancorp after the lender shocked Wall Street last week by revealing a surprise loss on its exposure to the struggling commercial real estate market. The downgrade dropped the bank's credit rating 2 notches from its previous level, marking a substantial loss of faith about the bank's ability to repay the debt holders. Now, considerable issues here, because you have to wonder, okay, what does this look like across the banking sector? And is this a great financial crisis 2.0, where previously, back in 2007-8, it was very much in the residential market? Okay, this time it seems to be in the commercial market. Post-COVID, people not returning to the office, meaning that demand for office space has been reduced massively, when really they didn't think that would be a case. And it's a little bit beyond just there being a tightening market, if you like. It's not necessarily due to interest rates just being higher that commercial property is now getting a bit decimated. It's really due to a change in working culture, perhaps. And it's probably one of the reasons why the banks wanted people back to the office so much. All of that massive office space in Midtown Manhattan, Wall Street office space. I guess in London, you've got Canary Wharf, which is about 25% empty at the moment. Things aren't looking good there either. And yeah, they needed to basically get people back to the office to make a case for actually retaining that office space. And there are, of course, other things to do with it, such as compliance and, the ability to actually do business face to face is very important. But one of the key reasons there is really just down to the costs. Okay, they have to basically make a case for keeping the office space. Now, the key thing here is how many other banks are there that might be in the same position? Are there any major banks, for example, that are in the same position? Are there any derivatives off of any of this that could cause further issues? They got rid of the CDO, but then they created other products that are a little bit more murky based off of the CDO. They collateralize as much as they can still, because it makes money for the banks. But regulations were brought in to provide sufficient liquidity buffers for most banks. This is one of the reasons why I say it shouldn't be a problem, because regulators are not going to want to be shown up here. It's not the same as 2008 when people were allowed a free-for-all. Liquidity buffers and what's known as the liquidity coverage ratio is actually very, very strong. Tier one capital is very, very strong in banking sector now, whereas previously it just was not. And that's why we kind of had 2008 and why even the large banks had to be bailed out. But in terms of how we are focused on this, I guess it's the spillover effects that matter the most here. We'll see how this plays out, but I think it will be contained purely to Bancorp. Other banks are probably going to take a hit, and you probably will see the overall banking index, say BKX, or what's the other one? There's a couple of others. KRB, I think, is the regional banking index. You might see those take a hit as well. But I think generally what we're going to find is this is relatively constrained to Bancorp. Now, we could look at, say, let's have a look at BKX actually. So if we look at the NASDAQ Bank Index, I don't think that's going to show anything just yet because it's from yesterday. But if we were to look at JPM, for example, has that shown any signs? Well, it's not. In post-market, it didn't show anything. So pre-market, it might show something up. But yeah, no signs just yet of there being any spillovers. It seems contained to Bancorp. Another theme that we're going to have to pay attention to, though, alongside everything else that's going on, Japan is going to enter the fray too as well soon, because it looks like they're having wage negotiations up into April. So it's an important time, and this could throw a spanner in the works of everything that we've looked at over the last 6 months. But it's fine. Things happen in markets. You just got to adapt. Is it better to have just one screen or loads of screens? Now, me personally, I only have one these days. It's a 32-inch monitor, though, so it's relatively large, for a computer screen. But I see loads of people with like 5, 6 screens, and I'm like, why do you need all of that? You've got to think of it from a streamlining perspective. Okay, you might look at quite a few markets, and okay, you might have to pull up certain data points at certain times. But I think if you have an information overload, what you're doing is you're taking way too many biases, and then you're kind of critiquing your own view with another view of another data point that might have just come out. And it's like you need to be able to maintain a specific point of view for longer than 5 minutes, because otherwise you're just going to start chopping and changing your mind all the time. If you're constantly taking in data and different pieces of information from different places because you have constant access to that information, it can get quite confusing for your brain, and you can end up confusing yourself. So these days, I like to portion off half and half of my screen. I like to have half of my screen with, research that pops up, news that comes out in a nice little column. And then the other half, just 2 or 3 charts. That's all I need to be able to look at to come to a decision. And then, if a piece of news comes out, I can quickly go and find the data and see what I need to see. But having 6 screens, unless you're working on an institutional desk, you've got loads of customers, clients that are phoning in orders, you need to be looking at certain things. It doesn't make sense. Leave that for the institutional guys who, quite frankly, they don't even want that many screens either. So I think reduce the amount of information that you're constantly taking in, and you will find it to be a massive benefit.